Historically, up to 90% of energy mergers and acquisitions fail to create any shareholder value. That is a staggering failure rate when you consider the sheer volume of capital at stake. Roughly $240 billion of oil and gas assets are slated to trade in 2025 alone. The leading mathematically proven cause of this massive value destruction is systematic overpayment by the acquiring company. This overpayment usually stems from a specific operational flaw. Buyers treat due diligence as a qualitative list of technical worries, a memo of concerns, rather than a strict financial model. Failing to quantify data room gaps into hard dollars transforms a potentially profitable asset into a guaranteed liability before the contract is even signed. An energy asset acquisition risk assessment stops describing an asset and starts pricing what could go wrong with it. It is a structured process that tests every claim in the data room against independent evidence. The framework translates evidence gaps into calculated financial deductions. Today, transaction risk extends beyond technical issues. Assessments must price regulatory exposure, carbon obligations, and geopolitical constraints. These deductions all route to a single critical output, the definitive walkaway price. Calculating and strictly adhering to this risk-adjusted valuation is the single highest leverage activity a buyer can perform during a deal. The foundation of any upstream valuation rests on Pillar 1, reserve and resource accuracy. Internal reserve estimates inherently carry a financial incentive for the seller to present an overly optimistic volume. Headline numbers must be tested against rigorous, independent audits governed by recognized standards, like those set by the Society of Petroleum Engineers, or the SEC. This graph contrasts an optimistic internal estimate against an independent SPE-PRMS audit testing specific technical variables. A discrepancy between proved and probable classifications directly swings the final purchase price by a massive margin. Accepting an unaudited reserve report guarantees the buyer will pay full price for phantom barrels that will never actually materialize. Next is Pillar 2, decommissioning and abandonment. Plugging wells and removing heavy infrastructure is a contractual obligation and the most frequently underestimated liability. To quantify this threat locally, the estimate for the UK continental shelf alone currently stands at roughly £44 billion. On a global scale, an expected $103 billion of decommissioning spend is aggressively forecasted between 2025 and 2034. The exact line item causing the most financial damage is well plugging and abandonment. It constitutes about half of that total spend and is the component most routinely deferred. Buyers must demand strict evidence here, an asset-level abandonment cost estimate paired directly with a firm schedule. Inheriting unpriced plugging and removal obligations means the buyer is essentially purchasing a massive future cash outflow, disguised as a producing asset. Pillar 3 is transition and stranded asset risk, a threat that represents over $1 trillion in lost upstream profits globally under plausible climate policy shifts. There is a severe transparency gap in the market regarding this exposure, primarily because sellers have zero incentive to disclose it during diligence. An analysis of 209 oil company financial reports found that only 4 actually highlighted their stranded asset risks. This chart illustrates projected revenue over a 20-year timeline. Relying solely on this base case artificially flatters long-dated cash flows. Buyers must explicitly model payback under alternative scenarios, starting with a low-demand pathway. A secondary stress test must be applied by modeling payback under a strict high-carbon cost pathway, which can quickly drive the asset's overall valuation into negative territory. Stress testing multiple futures exposes how an asset that looks highly profitable today can become deeply unprofitable once climate policy risk is actually priced in. Pillar 4 addresses carbon and regulatory cost. The current regulatory baseline is tightening rapidly, with carbon pricing systems now aggressively covering about 28% of global industrial emissions. The most acute exposure in the sector is methane. Oil and gas operations released roughly 81 million tons of it in 2024 alone. Methane carries a disproportionate regulatory risk due to an extreme warming effect that is roughly 30 times that of carbon dioxide. To account for this, a disciplined buyer maps the target's methane inventory and converts those volumes directly into rising operating expenses. Firmly, locking in operating cost assumptions based on today's lenient policies will artificially inflate the asset's value over a decade-long hold period. The final pillar is integration and people risk, which centers on the mechanics of bringing a new asset online and running it effectively. Inadequate post-deal integration is responsible for roughly 27% of all M&A value destruction. In highly specialized energy portfolios, the actual technical value of the asset often walks out the door when key personnel leave the company. Disciplined buyers demand explicit, funded plans for personnel retention, operatorship transfer, and IT systems integration. Unless these operational transition costs are mathematically priced into the initial bid, the projected financial synergies will never materialize. The final step of the framework rolls the findings from all 5 pillars into a definitive mathematical conclusion. Buyers attach a strict valuation adjustment to every material risk. These combined deductions are subtracted from the base case to generate a single risk-adjusted price. Establishing this rigid financial threshold is critical to complete before any face-to-face negotiations with the seller begin. Deploying this framework gives an advantage to buy-side partners, allowing them to allocate capital and shape post-deal strategy much earlier in the cycle. A base case modeled strictly at strip prices is a seductive trap designed to flatter long-dated cash flows. The unwavering discipline to reject bad deals separates truly elite energy buyers from the rest of the market. Calculating the true walkaway price is the only reliable defense against the ego-driven overpayment that destroys shareholder capital.